The Public Company Accounting Oversight Board, which is referred to as the PCAOB, does pretty much what its name says. It oversees auditors of public companies. As a result of significant audit failures, the PCAOB was created by the Sarbanes-Oxley Act of 2002, which is usually referred to as SOX or the Act. The creation of the PCAOB was also aiming to replace the self-regulation of audit firms and to establish stronger ethical and independence requirements. Since its creation, the PCAOB has established auditing, quality control, ethics, and independence standards and rules to be used by registered public accounting firms in the preparation and issuance of audit reports for public companies. The SEC is the PCAOB's boss and oversees the PCAOB's operations. This means that all rules and regulations proposed by the PCAOB are not effective until they are approved by the SEC. The SEC also approves the PCAOB's annual budget and appoints and removes all board members. Speaking of budgets, the PCAOB requires each public accounting firm that issues any audit report for a public company or broker-dealer to register and pay a registration fee with the PCAOB. Those registered firms then pay an annual fee. But the largest source of funding for the PCAOB comes from something that's called the Accounting Support Fee, which is an annual fee paid by companies whose financial statements are required to be audited by PCAOB-registered public accounting firms. All registered firms that audit public companies must perform their audits in accordance with PCAOB auditing standards. And PCAOB auditing standards require management of a public company to implement and maintain a system of internal control over financial reporting, which is also audited by the firm. But how does the PCAOB know that audit firms are adhering to their auditing standards? Well, every registered public accounting firm is subject to an inspection by the PCAOB. If a firm issues an audit report for over 100 different public companies in a calendar year, then the firm is subject to an annual inspection. If a firm audits fewer than 100 public companies, then they are inspected by the PCAOB once every 3 years. In the case of the largest accounting firms, the PCAOB generally takes a risk-based approach in selecting audit engagements to inspect. An inspection does not cover the entire audit engagement, but rather concentrates on challenging or difficult audit areas. Inspections identify whether there are deficiencies in how the firm performed its audits and whether there are weaknesses in its quality controls over public company auditing. Let's check out some of the more common audit deficiencies identified by the PCAOB.